Retiring early isn't magic. It's math you can do every month, starting today. Today, I break down a concrete, repeatable plan to invest for retirement early. This isn't a hype video or a get-rich-quick gimmick. It's a practical routine you can follow, even if your income isn't huge. Step 1 is figuring out your target number. You need a clear end goal before you start. A simple rule to begin with is this: aim for 25 times your expected annual expenses in today's dollars. If you think you'll spend about $40,000 a year in retirement, you'd set a target around $1 million. You'll adjust that as you learn more about inflation, taxes, and health costs. Don't overthink the exact number at first. The act of defining a goal makes the plan real. Next, build 3 automatic money streams that never rely on luck. Start with your employer match. If your 401k offers a match, contribute at least enough to get it. That is free money, and it compounds with every year you work. Then add a second line of automatic savings, such as a traditional IRA or a Roth IRA, depending on your income and tax situation. The goal here is to use tax advantages now to reduce the tax drag on your long-term growth. Finally, set up a taxable brokerage account that you fund after maxing out the 2 tax-advantaged accounts. Treat this like your growth engine for faster compounding as you get closer to your target. A simple, steady investment mix is crucial. For most people who want to retire early, a broad 3-fund portfolio works well: U.S. total stock market, international stock, and a bond index. A practical starting allocation is 70% U.S. stocks, 20% international stocks, and 10% bonds. If you're nervous about risk, start with a hotter mix like 60-25-15 and adjust over time. If you're more aggressive, you could go 80-15-5, but plan to rebalance as you age. The key is to keep costs low and choices simple. Choosing the funds matters more than trying to pick the next star fund. Prefer low-cost index funds or broad market ETFs with large, diversified holdings. For example, you could use VTI for U.S. stocks, VXUS for international stocks, and BND or AGG for bonds. The exact tickers aren't critical. What matters is a simple, broad exposure with low fees. Quarterly or annual rebalancing keeps your actual mix close to your target without chasing noise. Automation is the secret sauce. If you don't automate, you'll drift into sporadic saving and overspending. The plan is to set fixed percentages of your gross income to each account. A practical target for many is 15% to 20% of gross income saved toward retirement, plus any employer match. If you can, push higher to accelerate results. Each time your paycheck rises, increase the contribution by 1% or 2% automatically. This is how you compound your money even when you don't notice the change. A realistic path to early retirement also needs discipline around debt and expenses. Start by paying down high-interest debt first, because that rate of return is guaranteed by the math. If your credit card or personal loan carries, focus on that before investing extra cash. If your debt is manageable, you can invest the extra cash while keeping an eye on your overall spending. The idea is to keep the monthly cash print calm so you can stick with the plan for years. Another lever is living below your means now to fund more later. Small habits add up. Cook at home more, delay big purchases, and look for cheaper ways to get the same value. This isn't about deprivation, it's about creating space for your future you. The faster you reduce avoidable expenses, the sooner your investments can grow without needing a large raise. Side income is not optional if you want to accelerate early retirement. A second or third income stream can turbocharge your savings without touching the core life you want now. This could be freelance work, a small online business, or a part-time gig that fits your skills. The goal is to funnel the extra earnings straight into retirement accounts or the taxable portfolio you use for growth. Treat side income like a tool that unlocks more speed on your plan. Taxes will nibble at your gains if you don't plan it. The first order is to maximize tax-advantaged accounts as described. In taxable accounts, use tax-efficient investing. Hold stocks in the tax-advantaged spaces and let your bond funds live in retirement accounts to minimize taxes. Harvesting tax losses can help in a taxable account, but don't chase losses at the expense of your long-term strategy. The plan should feel quiet, not flashy, but it adds up over decades. As you invest for the long haul, you'll want to plan for the withdrawal phase too. A common rule is to aim for a safe withdrawal rate around 3% to 4% in real terms, but you should test this with your own numbers. Build a cushion with some bonds and cash so you can weather bad market years. If you run into a long downturn, you don't have to sell a lot of stocks at a bad time. A well-structured plan gives you options, not fear. Your health and insurance aren't just costs, they are savings tools. Make sure you have enough health coverage and disability protection. A solid plan reduces the risk of a big emergency derailing your retirement schedule. Insurance conversations aren't the most exciting part of money planning, but they're essential for keeping your compound growth intact. Now, let's walk through a practical month-by-month rhythm you can follow. At the start of each month, review your budget in 15 minutes. Confirm you're on track with your automatic savings. If your income changed, adjust the contribution percentages accordingly. Then select the funds for your new investments if you're contributing to a taxable account. Keep it simple. One decision per month, not 10 decisions every week. At the end of the year, do a light portfolio check. Rebalance if your allocation has drifted by more than 5 to 7 percentage points. Don't chase hot performers or try to time the market. The goal is consistency, not brilliance. A yearly rebalance preserves your plan's risk level and keeps fees down. To illustrate, imagine you're 28 with a modest income but a big dream. You start with a 70-20-10 mix, 70% in U.S. stocks, 20% international, 10% bonds. You fund your 401k to capture the match, add a Roth IRA, and contribute to a taxable account. Each year, you increase your contributions by 1% of your gross income. After 10 years, your portfolio has grown steadily, driven by automatic savings and the power of compounding. By your mid-40s, you might be sitting on a multi-million-dollar nest egg, depending on your earnings and market returns. The exact path will vary, but the principle stays the same. Start early, stay consistent, adjust slowly. There are common mistakes you want to avoid. Don't try to pick the best fund every year based on headlines. Don't skip your employer match or skip tax-advantaged accounts because you feel they aren't perfect. Don't panic during a market drop and pull money out. Market declines are part of the game, and staying invested is what builds wealth. On the upside, the plan is adaptable. If you get a raise, you can allocate a portion to faster growth or to cover higher living costs while keeping your savings rate intact. If your family grows or your expenses change, you can tune the allocation without losing the core habit. The power is in having a routine you can repeat, not a perfect forecast. The last habit to lock in is a simple review ritual. Every quarter, do a quick check. Are you saving enough? Is your asset mix aligned with your age and risk tolerance? Are you taking advantage of the employer match and tax-advantaged accounts? Do you have enough emergency cash? These questions keep you honest and moving forward without drama. This plan isn't glamorous, but it's reliable. It relies on boring consistency rather than disruptive tricks. The math works if you work the plan, month after month, year after year. The more you automate, the less you rely on willpower, and the more you benefit from compounding. Before we finish, a quick reminder about intent. Early retirement isn't about stopping work forever. It's about choosing how you spend your life and freeing time for the things you care about. The money piece should serve that life, not run it. Your plan should feel like a path you can walk, not a maze you struggle to navigate. If you've stayed with me this far, here's a simple summary you can take to the bank. Define a clear target number and plan for it using the 25x rule as a starting point. Set up 3 automatic streams, 401k to capture the match, an IRA or Roth IRA, and a taxable account for growth. Use a simple 3-fund portfolio with a tilt toward stocks while keeping some bonds for safety. Automate every step, escalate contributions with raises, and review once a year. Add debt payoff, side income, and tax planning to accelerate your progress. And finally, design a prudent withdrawal plan that protects you through market storms. If you're ready to start, pick one concrete action for this month. It could be setting up automatic contributions, choosing your fund mix, or calculating your target nest egg. Then commit to it for the next 90 days. Small steps, repeated often, become a real-life plan. Thanks for watching. If this sparked a practical idea for you, hit like, subscribe for more straightforward money tips, and share in the comments what concrete action you'll start this month. Tell me your target retirement age or the amount you're aiming for, and I'll try to help you refine it. See you in the next video.